Okay, so what was covered in the last class, guys?
With you or last?
No, your last class, not with me because it's been, I think, 2 weekends where I haven't taken class for you guys. Options was the last topic. Okay, right. Uh,
Yes.
so today we're going to do foreign exchange of a short, it's called FX. And once we finish that, at the end of the class, any doubts you have from any of the previous topics that is covered, and FX also, if you have any this and FX anyway throughout the class, you can just ask me if you didn't understand anything. Okay. Is the screen visible to you guys?
Yes, ma'am.
Okay. So the topic for today is foreign exchange. For short, it's called as FX as well, or it's called as Forex as well. So, in your opinion, what is an FX market or what is the foreign exchange market? If you have to give me like a one liner definition.
Which currency? So, what
Sorry, Nikhil, you were not audible. Can you type your answer out?
buying and selling of currency?
It is basically the currency market.
Currency market. Okay. Buying and selling of currency. Sorry?
Changing our currency with the foreign currency.
Changing of what is that a currency? You're on the right track, but what's the term?
Ma'am, can you please repeat the question? I have just joined. I'm so sorry for getting late. Can you please repeat the question?
What is foreign exchange? What's the
Okay,
foreign
thank you.
exchange market?
Okay. To give a try, a foreign exchange market is a market where you sell and buy the currencies
Okay.
that seeing the trend, bearish or bullish trend, according to that. And
Okay.
it involves many patterns
Okay.
like various like candlestick patterns or the news you have to follow up, keep a good follow up in order to see what you have, in order to basically anticipate
Okay.
the market, how it is going to perform.
Okay. So exchange of currencies is correct. So when you look at it, a simple definition is you exchange one currency for another currency. So our domestic currency is what? What's our domestic currency, guys? INR or Indian rupees. So either you sell the domestic currency and buy a foreign currency, or sometimes you might have a foreign currency, so you might sell it to buy a domestic currency. Or sometimes what could happen is you have a foreign currency and you sell it to buy another foreign currency. So the simplest definition of foreign exchange is nothing but you exchange one currency for another currency. Okay. Every currency has two things, or sorry, three things. One is a currency name. So, for example, you have United States dollars. Then you have something called as the currency code. So, in US, it's USD. And you have something called as a currency symbol. So, these three things are definite for a currency: the currency name, the currency code, and the currency symbol. Is everyone clear with this? Yes or no? Okay, so write this down.
Yes.
Write down what is FX, and then write down you might sell your domestic currency to buy a foreign currency, or you might sell a foreign currency to buy a domestic currency, or you might sell a foreign currency to buy another foreign currency. And every currency has three things that are there. that is called as the currency name, the currency code, and the currency symbol. Let me know once you're done writing. Is everyone done? Okay. So, can you guess how many currencies exist in the world? 26 is what Preeti says. Does everyone agree?
No.
Okay, then how many are there?
150 plus.
150 plus. Anyone else? Two hundred, 175, 180, 180. Okay. So there are actually more than 200 plus currencies that exist in the world. There are about 180 currencies that are circulating. Circulating meaning at least they move from one country to another country. Okay. Is that clear? So, currencies are further classified into four things. You have something called as major currencies, you have something called as minor currencies, and you have something called as non-deliverable forward currencies. So I'm going to write few currencies down. So other than that, you guys have to name some currencies for me. Okay. So the first obvious one I'm going to write is dollars. Next obvious one I'm going to write is Great Britain pounds. Okay. Then let's see. Obviously, I'll write INR because it is our currency. So, and one more, euros. So, other than these, can you name some currencies for me? Saurav says JPY.
Cuban pesos.
Cuban pesos. Do you know the currency code for it? Nikhil says
German
CAD.
euro.
Euros is here, no. So you can't say German euro. Then I can say France euro. I can say Sweden, Sweden, right? Okay.
Ma'am,
Dinar.
Sorry.
Frank.
What franc? Franc can be a name of a person, right? Be specific.
Dinar.
Dinar is good, but which dinar? Are we talking? Okay, Swiss francs. Yes, it's CHF. Okay, Russian ruble. Thanks, Chetan. That comes under this. Okay. Yuan. Prabhakar. What yuan? So AED is Arabian Emirati dirhams. Okay. Yes, Chinese yuan or CNY. Hong Kong
North Korean
dollars.
won.
Very good. North Korean won. Correct. So it's KRW. Kuwaiti dinar. Yes. Okay. Did I miss any names here? No, let me just check. No. Okay. Right. Any else? Singapore dollar. Very good. Yes, Singapore dollar. So I'm going to put that here. Then you have Riyals, Qatar. Okay. You have Bahraini dinar. Correct. Right. You have South African rand. I'm sorry. Please fall here. Okay. So not bad. Most of you gave me pretty good currency names. So your Five major currencies are US dollars, Great British pounds, European euros, Japanese yen, and Swiss francs. These are called as major currencies because on an everyday basis, these are traded in large volumes. Okay. Then you have your Canadian dollar, Australian dollar, Hong Kong dollar, Singapore dollar. You also have your New Zealand dollar. You have something called as the Swedish krona, Norwegian kroner, and you have the Danish kroner as well. These are called as minor currencies, meaning they are traded but not as high volumes as your major currencies. Then you have your exotic currencies like your dirhams, South African rand, Kuwaiti dinar, Bahraini dinar. You have something called as Israeli shekels, Turkish lira, etc. Okay. Then you have your NDF currencies like your Indian rupees, Russian rubles, Chinese yuan, South Korean won, and then couple of others which we'll see later on in class. Okay. Are we clear with major, minor, exotic, and NDF currencies? Exotic are traded but rarely traded. Okay, and NDF, we have a separate topic on NDF which we'll discuss a little later in class. Okay, Anupam? Okay, so write this down and quick question. Which is the strongest currency that exists? USD,
In terms of trading,
USD, everyone is saying USD. Sorry, who was that who just now spoke?
ma'am, I'm speaking in terms of trading or in terms of value.
I'm talking in terms of value.
Ma'am, Kuwaiti dinar.
Good question. Come back
Now,
question. Yes. Currently, $1 is how much in Indian rupees? I didn't see the rate today. Any guesses? Or anyone can check? 71, 74. Okay.
73.61.
Okay, so 73. Can you look up how much is one Kuwaiti dinar right now?
241.
241. Now tell me which is stronger.
Kuwaiti dinar.
Kuwaiti dinar.
Exactly. So your US dollar is the most liquid currency that exists. Okay? It's not the strongest currency. Is that clear? In terms of trading, yes. Because it's the most liquid currency that is there, in terms of trading, it is strong. But in terms of value, the US dollar is not as strong as the Kuwaiti dinar. Is that clear? Okay. So write down your major, minor, exotic, and NDF currencies. Nikhil, it could be various reasons, but one primary reason is Kuwait is a oil-rich economy. Okay.
Hello. Uh,
Yeah.
yes, ma'am. So I have a doubt, small doubt. So any currency which has what to say more value in trading, so that is stronger, right?
Not in terms of trading, yes, but not in terms of its strength. I just told you, right? $1 is 73 rupees, but one Kuwaiti dinar is 241,
Okay.
right? In terms of trading, because your dollar is one of the most liquid currencies that is, in terms of trading, yes, it is strong, but in terms of value, it isn't.
Okay. So
Okay.
when compared to Kuwait, it is stronger in trading
In
because it's
trading, yes,
liquid in.
US dollars
Yeah,
is the most liquid currency. In trading terms, it's the most strongest currency that exists because any country would accept US dollars.
okay. Fine. Thank you.
Okay. So now
Yes.
that we've discussed the types of currencies and what is FX, let's move on to the features of an FX market. Okay. The first feature is it's predominantly an OTC market. So what does that mean if it is OTC market?
Over the counter market.
Yeah, I know what OTC stands for. Give me the features.
Like the rate are not transparent.
The rate is not transparent. Brilliant. Yes.
High
What
risk,
else?
high risk factors.
High risk market.
Counterparty is unknown, ma'am.
Counterparty
Buyers and
unknown.
sellers are known.
Counterparty
Yeah, the
unknown.
counterpart.
Okay. What else?
Customized market.
Customized market. Brilliant. Okay. So that is what is meant by OTC market. So your FX predominantly trades in the OTC market. Having said that, it doesn't mean it doesn't trade on the exchange. It does trade on the exchange, but larger trading volumes are in the OTC market. Okay. It's a decentralized market. What does that mean?
There is no central agency to control this kind of a market.
Sorry, you went like a mile a minute, Piyush. Slow down a bit and repeat what you
Ma'am,
said.
there is no central agency
Mhm.
to monitor it.
That's why it's decentralized. No, you have central agencies like you have your, in our case, RBI, which is our monetary regulator.
Ma'am, there are no particular centers on which it is traded. It is traded all over the world.
Okay, now that sentence makes more sense, right? Saneen says no regulations. Does everyone agree?
No, ma'am. But
No, ma'am.
like in
No, ma'am.
India, we have
They are
There
like in
regulated
India,
through
we have
RBI only.
FDI regulator. FDI is the regulatory agency for forex.
Yeah, so it is a regulated market. So the reason why it's called as decentralized market, I'll put it in a very simple way. Now, when you buy a share, right, you become an owner of a share, correct? And nowadays the share, it's in dematerialized form, correct? Yes or no? Yeah. So now, when you want to, let's say, sell a share to someone else and you sold it, where does the share move from one account to another account or from your account to another person's account in dematerialized form? I'll give you a clue. It starts with, yes, depository. Correct, Anupam.
One depository moves it into another account.
It's in the depository, right? So all the securities are stored at the depository and it can move from one account to the other account only within the depository. So we can say this is centralized. Agreed? Yes or no?
Yes, yes, ma'am.
There's only one place the shares can move, it is in the depository. Whether you're buying or selling, it's only in the depository. It can move from one account to the other account. But when it comes to buying and selling currencies, you don't need a depository. All you need is a bank account. Now, you can have multiple bank accounts, correct? You can have bank accounts all over the place, right? So for currencies or for FX market, it's called as a decentralized market because there's no presence of a central location where the currency is exchanged. It can be exchanged from one account to the other, one bank account to another bank account. So it's called as a decentralized market. Is everyone clear with this point now? Yeah, right? It's one of the most liquid market that exists. In a day, the trading of volume in FX market, can you guess what the value is? In terms of value on an everyday basis, how much? 3.1 trillion. That's Preeti's guess. Anyone else? That's Preeti per year or day? Okay, not sure you're seeing it. Per day, 4 trillion is what Nikhil says. Anupam says 5 trillion per day. Anyone else? The volume of FX that's traded per day is 9.5 trillion a day per day. Okay, so multiply by around 365 almost. So 9.5 trillion would make it how much? How many zeros will be there? This is your 9.5 trillion a day. That is the value of the FX market on a everyday basis. Okay, so it's one of the most liquid markets that exist. You have low transaction costs but high volumes in terms of whenever a trade is executed, there are transaction costs attached to it. Like when you buy an equity trade or if you buy a bond, there is a certain amount of transaction cost that is associated with it. When it comes to FX trading, those transaction costs are very less as compared to your capital markets and your derivative markets. Okay, it's a 24 bar 7 market. What does that mean?
You can buy any day, anytime.
You can buy any day, any time. Okay. Am I missing? Hang on. Oh yeah, thanks. Saurav. Missed it. Yeah, there's a billion after a million. I forgot about that. Right? So now you guys might think when we're talking about 24 bar 7 market, that means it's running 7 days a week, 24/7 or 24 hours. But when you look at it, we discussed in our financial systems class, markets usually function on a Monday to Friday and usually between a 9 to 5 time, right? Agreed or no? Yeah. So how could the FX market be 24 bar 7? It should be more like a 24 bar 5, right? Yes or no? Time zone will be different, yes, but still the working days are considered Monday to Friday, right? Okay, to give you an example of it, so let me put it this way. Let's say I'm in India, it's a Sunday, and I need dollars urgently. Okay, and let's say your authorized money dealers like your Western Union, your Thomas Cook, and all are not open. And let's say the bank is also not open, right? So, how would you get dollars? Same time, for a Sunday, the Middle Eastern market is open. For example, you have Dubai, right? You can exchange your rupees for dollars in Dubai because in Dubai, Sunday is a working day. Okay. So similarly, there are certain countries where Saturday, Sunday is a working day. That's why your FX market is called as a 24/7 market, because in case in one market, if you can't get the currency, you can try in another market. Is that clear? Has everyone understood what is 24/7 market? Okay. So the last one, low margins but high volumes. I'll discuss this when I'm talking about how FX is used in, or FX is predominantly used for three reasons. Okay. So write these features down before we move on to the next one. What is FX used for? Let me know once you're done. Done? Okay. So yeah, FX is primarily used for three reasons. And you guys must have already seen it, which is speculation, hedging, and arbitrage. And a certain of it is also used for something called as need-based trading. So example of a need-based trading is as simple as if you're traveling to a foreign country and you need that country's currency, what you do is you exchange your domestic currency for that foreign currency. Okay, that's an example of need-based. Now, you remember that 9.5 trillion we were talking about, right? Out of the 9.5 trillion, 95% is used for speculation, hedging, and arbitrage, and 5% is only used for need based trading. Okay, is everyone clear till here? Okay, so under need based, on a larger volume, you have something called as global funding and capital repatriation. So, what is global funding? As the name suggests, you're planning to invest in a foreign market. So, let's say you're an investor sitting in India, you want to invest in the London market, right? To invest in the London market, you need GBP, but you have INR. So, what will happen is the fund manager would convert your INR into GBP, and then based on your interest on what you want to invest in the market, he'd take that GBP and invest it in the London market. Is this clear on what is global funding? Yeah. Now, what is capital repatriation. So we'll take the same example, but here's the thing that has happened now. The investor wants to close down his investments in the London market, and there was couple of years there was a good example of why people would have closed down their investment in the UK market. What was that reason? What happened a couple of years before? Brexit, exactly. So let's say the investor, because of Brexit, wants to close his investments in the London market. So what the fund manager will do is he'll sell off whatever is invested in the London market. He'll receive GBP. He'll convert that GBP to INR and give it to his client or his investor that was there. So capital repatriation is nothing but bringing back your capital. Is this clear on what is global funding and what is capital repatriation?
What is Brexit?
You don't know what is Brexit?
No.
Okay, you need to read about Brexit, Saujanya.
Okay.
To give you a gist of it, UK was part of something called as the European Union. Okay, what this meant was when it was part of the European Union, it could borrow at cheap credits from European banks and additional to some other things that were given to them as being part of the European Union. But then Britain decided to exit from the European Union. That is called as Brexit. Okay.
Okay.
Okay, is everyone clear with what is global funding and capital repatriation under need-based trading?
Ma'am, I have a question here.
Mm-hmm.
Why we are choosing global funding instead of directly converting Indian rupees into GBP?
Because it
Like,
won't
is there
be,
any tax?
no, not that. It won't be easy for you to do it.
So,
You
there is
would,
no tax?
tax is a different thing. Tax would be on your investments that you've done in the London market. Converting your
Okay.
this thing, your person who's helping you convert, there will be some commission charged. Actually, in your FX trading, there is no commission charge. We'll discuss about that later. They earn their this thing on something called a spread, right? The reason why this person is not direct, because you're not investing like 1,000 rupees. You might be a person
Yeah,
who's
right.
investing millions. You can't walk to, let's say, Western Union and tell them I want 1 million pounds and here's the rupees. Now that will be a big this thing for Western Union also, whether they'll be able to provide that many GBP for you. And another thing is, such large transactions are not allowed at authorized money dealers. Such large transactions should go through a bank so that the regulator can have a purview on it. Okay.
Okay.
So, Saurav, what is capital repatriation is basically nothing but bringing back my investments in a foreign market that I've done. So, the example that we have taken, like in global funding, investor invested in the London market. So, his rupees was converted to GBP and then invested in the London market. Repatriation is he wants his investment back. So, what happens? Whatever investment is done in the London market, it's liquidated. In return, the fund manager gets GBP, but then the person sitting in India, GBP won't be of any use for him in India. So the GBP gets converted back to INR and given to him.
Hello.
Okay.
Hello.
So write this down under uses of FX market, under need based, this much, and then we'll go into how FX is used in speculation, hedging, and arbitrage.
Hello. Hello.
Nikhil.
So the repatriation tax similar to the like NRIs who are investing in the India because they repatriate the money back to their foreign country. So
If NRIs first of all are called as what? Non-resident Indians, right?
Yeah.
Right. So if there are foreigner and the foreigner is invested in the Indian market, and then he's closed down his investment and he's taken back his whatever money is invested in the Indian market, which is then converted to his domestic currency, it will be called as capital repatriation.
It's a repatriation, same thing.
Repatriation is nothing but bringing back.
Yeah.
Okay. Done? Okay, so before I go on to how FX is used in speculation, hedging, and arbitrage, there's a small concept I need to talk about. Something called as flattening out a currency. Have you heard of this term before? Have you guys heard of this term flattening out a currency? No? Okay. So basically, flattening out a currency means you're trying to realize no profit, no loss on a currency. So, for example, let's say if hypothetically you bought 100,000 US dollars for which you sold, again, hypothetically, I'm not putting any rate, 1 million rupees. Okay, and now you want to realize a profit on the dollars. So what you do the next time around is you would sell so much USDs. I didn't put a rate, so I can't actually show you with this thing, but I can show you when I'm doing the example. But to flatten out the INR, meaning if you don't want to realize any profit or any loss on the INR, how much you sold before, the same exact amount you will buy back. Okay, so you'll realize no profit or no loss on the INR, but you'd realize a profit or a loss on the dollars basis which your speculation goes. Does this make sense, or you want me to repeat it? Sure. So to put it in a simple way, let's say your bank account has 10,000 rupees. You want to make the balance zero. What you'll do? Withdraw how much? 10K, exactly. So the similar concept applies here. If you do want to realize a profit or loss on a certain currency, how much you sold the first time around, the second time the exact same amount you'll buy back, or vice versa. If you've bought 1 million here, then the second time around you would sell 1 million exactly to realize no profit or no loss, which is called as flattening out of a currency, or try to realize no profit, no loss on the currency. Is this clear now? Okay, so write this concept down and then we'll discuss what is or how FX is used in the speculation, hedging, and arbitrage.
Ma'am, I have a question. Why would we do that? As in not realizing any profit or loss. So where is flattening the currency, implemented?
I'll show you when we discuss speculation, hedging, and arbitrage.
Okay.
Okay. Flattening out is not to hedge risk. It's basically you flatten out one currency because you want to realize a profit or on the other currency if your speculation goes right. If speculation goes wrong, then you will realize a loss on it. Now, no one would want to realize a loss, obviously, but sometimes speculations can go wrong as well, right? Everyone's done? Can I move on to or show you guys examples of how FX can be used in a speculation, hedging, and arbitrage? Okay. So let's say I am an FX trader who sits in London. So what will be my operating currency?
GBP, ma'am.
Exactly. My operating currency will be GBP. So let's say I have about $1 million with me right now, sitting with me. It's not being traded yet. Okay. But I'm looking at the market and I'm seeing, let's say, as of 1st July, the GBP dollar rate is going to be 10. So GBP dollar rate is going to be 10. What this implies is, as of today, $1 or 1 GBP equals 10 US dollars. Okay, is everyone clear with this? 1 GBP equals 10 US dollars. My speculation is, as of let's say 3rd July, GBP is going to appreciate against the dollars. So if it's going to appreciate, will the rate be higher than 10 or lower than 10?
Higher than 10, ma'am.
Exactly, it will be higher than 10. So let's say my speculation is it's going to go to 12. So what I do is on 1st of July, that US dollars of 1 million that I have, so 1 million. That 1 million US dollars, sorry about the decimal places here, I don't know why it is. Don't know why it's going, but yeah, let's say 1 million. What I'm going to do is that 1 million US dollars, I'm going to sell it. Okay, at a rate of 10. Now, how much GBP will I get for selling the 1 million US dollars? How I'll do that calculation is, so we said 1 GBP, you guys can see the screen, right? Yeah. So we said 1 GBP equals 10 US dollars. So we have 1 million US dollars. For that, how much GBP are we going to get? It's a simple matter of cross multiplication. How much will you get? So it will be what? 1 million divided by 10. Exactly. You'll get 100,000 GBP. Okay. Now, remember we discussed the concept of flattening out the currency. So we want to obviously realize the profit on the appreciating currency. So the appreciating currency is GBP here. So as of 3rd of July, let's say the rate went to 12. So we do want to realize a profit on the dollars. So what will we do on the dollars now? If we sold 1 million on the 1st, if we don't want to realize a profit on the US dollars now, what will we do on 3rd July? Buy exactly how much? Same, exactly. We'll buy 1 million US dollars. So we realize no profit, no loss. But now 1 GBP is 12 USD. So for 1 million USD, if you have to buy it back, how much GBP will you have to sell? So again, cross multiplication. So how much will that be? This divided by, so it's 833,000, so 83,333, we'll round it off, 83,333, right? So let me put it this way. Have you received, have you done a profit on the GBP or loss on the GBP? Loss. How is it loss, guys? Look at it this way. When I sold 1 million US dollars, I received 100,000 GBP. Now I had to buy the exact same amount of dollars back, for which I had to only spend 833,333. Out of the 100,000 that I have, I only spent this much. So remaining will be my loss or profit?
Profit, ma'am. 16,667.
Exactly. That's a profit. Is that clear? Guys, who say Anand, Anupam, Saurabh, is it clear now? Saurabh, Anand, no. Let me put it this way. You have 1 million US dollars. Okay. You gave the 1 million US dollars to me. In return, I gave you 100,000 GBP. With me so far? Okay. Now, what you did was, you wanted to buy the exact same amount of dollars back from me. So what happened? You bought the 1 million US dollars back from me, for which you only paid me 83,333. So out of the 100,000 GBP that you had, you only gave me this much to buy that $1 million. So the remaining GBP becomes your profit, correct? Saurav, is that clear? How we did the calculation here, right, Saurav? What happened? When the rate was 10, for 1 million US dollars, I had to spend 100,000 GBP. Now when the rate was 12, for the exact same amount of dollars that I wanted, I only had to spend so much GBP. Is it still unclear to you or it's still confusing? Saurav? Listen carefully, Saurav. Let's say you have 1 million US dollars with you. Okay? You sold that 1 million US dollars to me, for which I paid you 100,000 GBP at a rate of 10, where 1 GBP equals 10 US dollars. With me so far? Okay. Now, when the rate was 12, what you do is you wanted to buy back the exact same amount of dollars, which is 1 million. Okay. So what happens is you pay me only 83,333 GBP and you get your $1 million. Now, the first time around, how much GBP did you have, Saurabh, when we did the first leg? GBP, not dollars. Out of that, you paid me 83,333 to get the $1 million back. How much is remaining with you then, GBP? Now, is that your loss or is it your profit? For the same amount of dollars, you have leftover GBP. Is that your profit or is that your loss? Yes, Anand, it's because GBP appreciated. If GBP depreciated, let's say instead of 12, it went to, let's say, below 10. Okay. Now, see this. Will it be a profit or will it be a loss?
Loss of 25,000, ma'am.
Yes. Why? Because the speculation went wrong. Instead of GBP appreciating against dollars, GBP depreciated because now, exactly. Why? Because here for every GBP, you had to give 10. But now for every GBP, you have to give 8, which is less amount of dollars. So GBP depreciated. So if you did this, it would have become a loss. Is that clear now? Is this clear? Saurav, did you understand? Okay.
Ma'am, I have one doubt, ma'am.
Tell me.
Ma'am, here GBP you are comparing with USD. With any currency we can take, right, ma'am?
So the funda is simple. You see the currency, the exchange rate, you find out which currency is appreciating. If the currency is appreciating, generally to make a profit on that appreciating currency, you'll always buy it at a lower rate and then sell it at a higher rate to make a profit while you flatten out the other currency.
Okay.
Okay. Is everyone clear with this? Okay. What if, let's say, you still wanted to realize a profit on the GBP, but the rate is depreciating. Then what you would do is, instead of buying it first, you would sell. So let's say, hypothetically, if let's say you want to sell 1 million GBP, okay, so at a rate of 10. So here, how the calculation will be now, it'll turn around. It'll be like this now. Yes or no? Okay. So you would then get 10 million US dollars. Okay. Now, again, you don't want to realize a profit on the dollars. You want to flatten out the dollars. So next time around, you would sell the exact same amount of dollars, which is 10 million. Okay. But now the rate is 8. So it will be 10 million divided by 8. Get 1 to 5. Understood what I did here, guys? Yeah. The difference here was GBP was appreciating. So what I did first is I bought it and then I sold it and I flattened out the US dollars. Here now, the GBP was depreciating, but I still wanted to make a profit on GBP. So instead of buying it first, what I did was I sold it and then I bought it. Again, I flattened out the USD. Is that clear?
Just a quick summary. So first case, you bought it, right? And once there was an appreciation, you sold it, so you get a profit of whatever 16,667, whatever that is.
Yeah.
And then the second scenario, it's 10, right? The exchange rate is 10. So you sell whatever you have, right, to get a profit. And again you buy the same right?
And I
Whatever
flatten out
shares,
the dollars.
flatten out the dollars, and I get a profit.
It's there in
Correct?
the calculation, correct? So when the currency is depreciating and I want to realize a profit on the depreciating currency, I will sell it first and then I will buy it while I flatten out the other currency. If I take the same example here, folks, so we'll take the same thing. Let me just put it in another sheet. Let's say I want to make a profit on the dollars now. Okay. So dollars is appreciating or depreciating here? Depreciating, exactly. So I'll sell the $1 million. If I sell the $1 million, how much GBP will I get now? So, hello. Can you guys hear me? So GBP USD 1 equals 10. So you sell the 1 million US dollars, right? So you buy how much? 100,000 GBP. With me so far? Yeah. Now, I don't want to realize a profit on the GBP. So I want to flatten it out. So if I want to flatten it out, how much GBP am I going to sell? Exactly. I'm going to sell 100,000 GBP. For which, how much USD am I going to get now? Same. $1.2 million USD. Right? So I've made a profit of what? 200,000? Yes or no? Yeah. So always remember this, folks. So always remember one thing. If you want to make a profit on the appreciating currency, you will buy it first at a lower rate and then you'll sell it at a higher rate while you flatten out the other currency. Is everyone clear here? Yeah. If you want to realize a profit on the depreciating currency, you would sell it at a higher rate and you buy it at a lower rate while again you flatten out the other currency. Is everyone clear till here? Okay, so these are examples of your FX in a speculation. Okay, and I've written that note also here, so you can make a note of that. So write this down and let me know once you're done. Done? Okay, let me know when you're done.
Hello. Hello, ma'am.
Yeah.
Ma'am, here what rate is depreciation is happening now, ma'am. Here one extra zero you have put while buying.
Where?
the
Which
GBP.
one? Here?
And this one, ma'am. Because we are buying with higher rate now. Sorry, we are selling with high rate and buying with low rate. Here one extra zero you have put, ma'am. Just see, ma'am.
When I wrote it here, is it? Yeah, there are 4
Uh-huh.
zeros. No. How is it extra?
Ma'am,
Here,
1 million divided by 8 we are doing, na?
hang on. Here I put an extra 0. There we go.
Yes, yes.
Now it is correct. Hey, no, something is wrong here. Wait. No, it was correct. No, it was 10 million. It was not 1 million. It was 10 million.
It's 2 million?
10 million US dollars. See?
Okay, then it's correct, ma'am.
Then it's correct, no? You gave me a scare.
Yes,
I
yes.
thought I did it wrong.
I thought it's 1 million, ma'am, that's why.
You gave me a scare for a second. I thought I did it wrong. And I was like, okay. Everyone done writing? Yeah. Okay. So next, this was examples of speculation. So now we'll talk about arbitrage before we go to. Okay, Preetham, how much time do you need?
Hello.
Yeah, Nikhil.
Like we say that we have the foreign use of India. Everything.
I can't hear
So
you.
much related to the audible.
No, there's a lot of interruptions from your side. Type down, no, what do you want to say? Can I continue?
Yes, ma'am.
Okay. So, Anand, hurry up. We only have 2 hours today and I have to cover a lot still. And we're already at 3:30. Okay. So, example of how FX is used in a arbitrage trading. So, what is the concept of arbitrage? Arbitrage always works under one concept. What is that?
Ma'am, buy low, sell high.
Exactly.
Selling in
Buy low,
Buy
sell high.
exactly.
Profit out of it.
Okay. So, using the same funda or using the same example, the difference now is I'm seeing this rate in the London market and I'm seeing this rate in the US market. So what I do is on the 1st of July, I sell 1 million US dollars in the London market for which I get 100,000 GBP. Same time, what I do is in the US market or simultaneously or maybe few second difference or a minute difference, what I do is then I buy the same exact amount of dollars back in the US market for which I only have to spend so much GBP and the remaining becomes my profit. Does this make sense? Same day, different markets, bought low, sold high. Is it clear?
Yes, ma'am.
Okay. Write this example down. So here also I would change it. It would be on the same day. And this, let's say, is in the, or if you want to switch it around a bit, we can make this as the US market and this as the London market.
Ma'am,
Yeah.
hello.
Yeah. Can you hear me?
Ma'am, as we have buy, ma'am, yeah. Ma'am, according to the B cell, we have in London market, na?
Sorry, your last bit got some interruption was there.
So, according to cell B, we are buying in the London market.
Cell D. Which example? This example or the first one?
Ma'am, B for Bombay, first example.
Okay.
According to cell B, we are buying in the London market.
Yeah, we're buying GBP.
We are buying. We are buying. Okay, we are buying GBP or ma'am, but ma'am, we are okay. Now
We're
it's
buying
clear.
GBP. See undercut.
Okay, ma'am, it's clear.
Okay, it's clear now. Okay.
Yeah.
Yes. Okay, so Saurav says this happens in NSE and BSE also. Yeah, you can do it in NSE and BSE as well. There'll be like decimal place difference.
Ma'am, so speculating is something that may happen in long run. Like now it's $10, tomorrow maybe after a few months it'll be 12. But in arbitrage, it's like on the same day you buy it and sell it in a different market.
Exactly. Your arbitrage market, the concept is very simple. It's always you're buying low and you're selling high, and it's in the different markets. Whereas your speculation can happen in the same market over a period of time.
Okay.
Can I continue?
Yes, ma'am.
So the next bit is FX in a hedging. So let's say I'm a person who imports. Okay, Preeti needs a minute. Done, Preeti? Okay. So let's say I'm an importer and I want to import some products from somewhere in the Europe that is worth around 1 million euros. Okay. As of 1st of July, the Euro INR rate is 100. What it implies is for every euro, I'll have to spend 100 INR. So as of 1st of July, if I want to buy a million euros, I have to convert 100 million INR. Is everyone clear till here? Yeah. The thing is though, the person who I have to pay the 1 million euro to doesn't want the payment on the 1st. Okay. Say they want the payment on the 9th. That is one scenario. Second scenario is I don't have 100 million INR as of now to convert it to 1 million euro. Okay. And my risk, what would be my risk? as of 9th of July, if I have to pay that person 1 million euros, what will be my risk?
Market fluctuations.
Yes, or in other words, what could happen? Nikhil, if euro depreciates, then it will not be a risk for me. It will be a profit, or it will work in my favor. Appreciate. Exactly. Or if INR depreciates. So if euro appreciates, it will be my risk. Right? So let's say the market speculation is as of 9th July, euros will become 120. That means each euro I'll have to spend 120 INR to convert. Now, if I have to get 1 million euros, I'll have to convert 120 million INR. Yes or no? Which is a risk for me. How do I hedge that risk? I would go to a foreign exchange bank, or I might go to an Exim bank, and I would enter into a FX forward deal with them on the 1st of July, saying I will buy 1 million euros at a rate of 100 INR on the 9th of July. This is the agreement that I've made, a forward agreement. Do you agree it's a forward agreement? Yes or no?
Yes, ma'am.
Yeah. So as of 9th of July now, even if the rate goes to 120, will I be spending 120 per euro or will I be spending 100 per euro?
The 100 euro.
So you could say I have hedged my risk. Yes?
Yes.
So this is an example of how FX can be used in a hedging. Is that clear? If the rate goes below your speculation of 120, or let's say if the rate went to 80, you can cancel the deal. You might just have to pay some cancellation cost. It's OTC market now. Okay, Saurav? And when it comes to your markets, there's always one person will speculate one way and the other person will speculate other way. Is that clear? Have you guys understood an example of hedging? In FX, in OTC market, that's why the reason default risk is higher, na? You can have defaults. But then here's the catch. If you always default, then people may not want to enter into deals with you. So you might lose business. You might have a reputation damage.
But it is over the counter market, so trade settlements are not agreed here, na?
Trade settlement will not happen, no? Then if you've defaulted. Settlements will always happen later, no? Unless it's a same day trade.
Yes, ma'am.
Okay. Have you guys understood what is hedging?
Yes, ma'am.
Okay. In the previous example, no, where this also could be an example of hedging. So let's say if you're thinking that the GBP is depreciating to get get a profit on the GBP, you might do this. This is also an example you could say of hedging, but this would be a better example. Okay. Can I continue? Okay. So the next bit that we're going to discuss is the obvious thing, exchange rate. So what is the exchange rate?
Rate at which one currency is exchanged for the another.
Exactly. The simplest example of exchange rate is the rate at which you exchange or you sell one currency for another currency. Okay. Now your exchange rate can be quoted in two ways. You have something called as direct quotation and you have something called as indirect quotation, not fixed and floating. That is interest rate. That's not exchange rate. Exchange rate will be floating on a day-to-day basis anyway because it changes. Okay. Direct quotation is when one unit of a foreign currency is quoted in domestic currency. So, for example, our domestic currency is INR, correct? So, when you see a quotation like this, USD/INR equals hypothetically, let's say 75, which implies that one US dollar equals 75 INR, where this is a foreign currency, this is a domestic currency. So, a unit of foreign currency quoted in domestic currency. This is called as a direct quotation. Is everyone clear with this? Yeah?
Yes, ma'am.
Indirect quotation is a unit of domestic currency quoted in foreign currency. For example, let's say 1 INR equals 0.85 USD, where INR is our domestic currency and USD is a foreign currency. So, unit of domestic currency quoted in foreign currency is indirect quotation. Is this clear to everyone? Okay. Let's say if this quotation was given in the US market, will it become direct or indirect quotation then?
Ma'am, indirect.
Exactly, it will become indirect because now the domestic currency in the US market is US dollars. So, unit of domestic currency quoted in foreign currency is indirect quotation. So, is everyone clear with direct and indirect quotation? So, to continue, your exchange rate is usually quoted up to 4 decimal places for most of the currency pairs. Currency pairs is nothing but, this is an example of currency pair, USD/INR or GBP/Euro. So, it's called as a currency pair. So, usually exchange rates are quoted up to 4 decimal places, except if a currency is paired with Japanese yen, then it is up to 2 decimal places. Okay, is this clear to everyone? Yeah. Now, like your equities prices in the market changes, similarly your exchange rate also changes in the market. So when your exchange rate goes up or down, it is denoted in something called as percentage in point, or for short it's called as pips. So let's say hypothetically Euro/GBP rate is quoted as 1.1234 as of today. Tomorrow, the rate went from 0.1234 to 0.1235. This denotes a 0.0001 rise in the exchange rate, which is called as 1 pip. Is this clear? If from this rate it went to this rate, which is from 0.1235 to 0.1245, which is a 0.001 rise, that is called as a 10 pip rise. Okay, so similarly 100 pip, 1000 pip, and then went up or down by not 1 pip here in this case. Oh yeah, sorry, went down by 1 pip if it went down from this rate to this rate. So the exchange rate can go up or down by pips. Is this clear? One example in Japanese yen, then if it is Japanese yen, it's up to 2 decimal places, right? So it can either go up and down by 100 pips or 1000 pips, or because it's not more than 2 decimal places. Finish writing. What is exchange rate? What is direct, indirect, and pips? Yes or no? Strong no by Divya, so I'll give it another 2 minutes. Sure, Preeti. So exchange rates can go up and down in terms of pips, or it's denoted in terms of pips. Okay. So we took an example of this exchange rate where, let's say, as of today, the rate was 1.1234, and tomorrow if it went to 1.1235, so it's a 1 pip rise. So from 34 it went to 35. So next day from this rate, it went to 4.5. From 3.5 to 4.5. So that's a 10 pip rise. Okay.
Okay, so that means we are counting upon the fourth digit from the left side of decimal. Whatever fluctuation there will be, we will count the pips.
Right side of the decimal when you're facing it.
Hello. When I am facing it, then fourth from the decimal, I guess.
Fourth from the right, from the decimal side when you're facing it.
Okay, so if it is changing like from 45 to 55, then it is 10 pips. Like you have given an example of 35 to 45.
Yeah.
Okay. Yeah. Thank you.
Yeah.
Hello.
Hi, Nikhil.
Yeah, I want to ask about the foreign reserve every country is having. So in the form of currency or in the form of anything they can have.
Nikhil, that question we'll leave at the end, okay?
Okay.
Done writing? Okay. So can I continue? Okay. So next thing we're going to discuss is who are the major participants in the FX market. Give me 1 second. I just need to drink some water. Sorry about that. Okay. So who are the major participants in the FX market? The major participants in the FX market are called as market makers. Market makers are nothing but, it can be a firm or individual who provides two-way quotation of bid, meaning the buy rate, and ask, meaning the sell rate. Okay, so buy rate meaning at what rate they want to buy a currency, which is called as bid rate, and at what rate they want to sell a currency, which is called as ask rate. The people who are called as market makers in the FX market are your commercial banks, investment banks, brokerage firm. They are heavily involved in your speculation, hedging, and arbitrage. Is this clear? Okay. Then you have people who do need-based FX trading. The most simplest one is us as individuals if we're traveling to foreign countries. Otherwise, in terms of need-based trading, your central banks and authorized currency converters like your Western Union, Thomas Cook, they do need-based FX trading. Okay. Now, in your FX trades, there are no commissions charged. The profit is earned through spread, which is the difference between their bid and ask rate. Two-way quotation meaning they give at what rate they want to buy the currency and at what rate they want to sell the currency. That is called as two-way quotation.
Okay. Does that mean a same person is buying and selling? Because
Yeah.
one person will buy and one will sell.
Same person buys and same person sells. So if he wants, like for example, if the person wants to buy dollars versus INR, then he will say if he has to sell the dollars to you, what rate at which he will sell, which is the ask rate. Okay. If he wants to buy the dollars from you, at what rate he will buy it, which is the bid rate.
Okay. So that means because there is a pair, so if we are buying one currency, then automatically we are selling another currency. That's how it becomes.
Yeah, that's obvious, right?
Yeah, right. Okay.
So now listen carefully, you guys. Market makers are the ones who give you the quotation. You, on the other hand, who accepts the quotation will be called as class, meaning you cannot go and argue with the market maker to change the rate. Okay. To put it in a simple way, nickel intermediary can be involved, I cannot be involved also in this. Okay. So put it in a simple way. Have you guys exchanged domestic currency for foreign currency anytime? Have you done it? What have you exchanged, Nikhil? Rupees for what?
No, actually, as I did in the department assessment, so NRIs came for the exchange in the GBP pound
Okay.
in the INR.
So now let's say when the customer came to change the GBP to INR, that means you bought the GBP from them and you gave them INR, correct?
Yes.
Did you give them less INR or more INR?
Sorry, ma'am.
Did you give them less INR or more INR?
Less. What do you mean? I don't remember.
Okay. I'll show you the example anyway. You were the bank, let's say. Okay, you had to buy back the GBP from them. But when you are buying back the GBP from them, you gave them less amount of rupees in return. Whereas, let's say if the same person came to you and said they want to buy GBP from you, you would charge them more amount of rupees. Did you understand? So you are the bank, client came or customer came. For example, let's say now the customer wants to buy GBP. So when they're buying GBP, you charge them more INR. Okay. Now the same client comes back or same customer comes back and says, here's the GBP back, give me INR. But now you give them less INR. Yes or no? Okay. You do this, right? You should know, right? Whether you're giving them less or more INR. This is because of the difference between the ask and the bid rate. When you were buying the INR back from them, you were paying them less. I mean, buying the GBP back from them, you were paying them less INR. But when you had to sell the GBP to them, you took more INR. Okay, anyway, you'll understand with this example. So let's say there's a market maker. Okay, he gives the quotation of GBP/SGD equals 20/25. So what you always need to know is the currency on the left of the slash is referred to as base currency. Okay. The currency on the right of the slash is referred to as quote currency. The rate on the left is referred to as bid rate, which is buy. And the rate on the right is referred to as ask, which is sell rate. This is from the market maker's point of view. So now, if the market maker wants to buy a unit of the base currency, he will be using the bid rate. So in this example, 1 GBP would equal 20 SGD. Is everyone clear till here? Yeah. Now, if the same market maker has to sell the GBP to you, he'll use the ask rate, meaning for 1 GBP, he'll charge you 25 Singapore dollars. Does this make sense now? Okay. Always remember, you first understand what the market maker is doing on the base currency. If he is buying the base currency from you, is he going to use the bid rate? Okay. If he's selling the base currency to you, he's going to use the ask rate. Is everyone clear with this? Okay. So let's say if I'm the market maker, I've given you this quotation and you're the class and you have 100 GBP with you. Okay. Convert it to SGD now. How much SGD will you get for your 100 GBP? If your class and I'm the market maker and I've given you this quotation of GBP/SGD equals 20/25. Preeti says 4K. Does everyone agree? Anupam, I've given you this quotation of GBP/SGD equals 2025. I'm the market maker who gave this quotation. You're the class. You have 100,000 GBP with you now. You have to convert it to SGD. So convert it and tell me how much SGD will you get now for your 100,000 GBP. So Nikhil and Preeti and Nikhil say 4,000. Himanshu says 4,000.
5K. 5K.
Saneen says 2. Anupam says 2. Ritesh says 2. Sorry, who was that who said 5K? Piyush says 5K. Which rate have you guys used? Saneen and Anupam, which rate have you used? Buy. Can you tell me why you used buy rate?
As market maker has to buy this 100,000 GBP, so we should use the buy rate.
Correct. Exactly right, Anupam. That is the right answer. Now, I said you're the class, you had GBP. As the market maker, I'm going to buy the GBP from you, so I'm going to use the bid rate. So 1 GBP equals 20 SGD. So for 100 GBP, how much SGD I'll get? 2 million SGD. Is this clear to everyone? Yeah?
Yes, ma'am.
Out of the 2 million, let's say you spent 1.5 million SGD, you're left with 500 SGD now. Convert it back to GBP. What rate will you use now? Now, as the market maker, I'll be selling the GBP to you. So, I'll use the ask rate, which is 25. So, 1 GBP equals 25. So, for 500 SGD, you'll get 20,000 GBP back. Is this clear? So, guys, always remember one thing. How did you get 100? 1, 2. How, Saurav? You have 500,000 SGD, not 500,000 GBP. Okay, here's the calculation. See. Okay. So, always remember one thing, guys. You are always the class. Okay. So, whenever the market maker gives you the quotation, always remember one thing or always understand one thing. What is the market maker going to do on the base currency? If he is going to buy the base currency from you, he's using the bid rate. And it's just a matter of plugging in the numbers and then you'll find the answer. If he's going to sell the base currency to you, he's going to use the ask rate. Is that clear?
Yes, ma'am.
Okay. So here is a classwork or rather homework for you guys. Write this down quickly. Okay. So you're planning to go on vacation to Hong Kong. Your two-way flight tickets cost 1 million rupees. You plan to stay for 4 days and 4 nights. The cost of hotel per night is 100 Hong Kong dollars. Your expenses per day is 500 Hong Kong dollars. You plan to visit Disney World. The cost of the ticket is 300 Hong Kong dollars. You plan to buy gifts worth 1,000 Hong Kong dollars. You have 2 million INR. Exchange rate that is given is 5/6. Okay. So do you have enough money to travel for expenses, stay, visit Disneyland and buy gifts? And if any remaining HKD is there, converted back to INR. Okay, so quickly write this problem down and then we'll continue. Done? Anupam, I need the breakdown of everything. Okay, so next class you can this thing, or I will copy paste this at the end of this notepad, so it will be visible in the video. Okay, the solution for this problem. Okay, right. So can I continue? Okay, so next we are going to discuss something called as trade economics of an FX trade. Have you guys heard of this term, trade economics? Yes. So what is trade economics? What is trade economics? Riti says, was that yes for continuing or yes for what is trade economics? This was not discussed in your forwards and futures class. No, seriously.
No, ma'am.
Maybe it is a life cycle where we anticipate the dates, or not anticipate, we will actually count upon the dates. What are the dates, like uh, like the three dates are there in which we settle the payment and execute the order and everything like that.
It's part of your trade life cycle, but you're not incorrect. You're partially correct. So trade economics of forwards and futures was not discussed at all, which is weird. Okay, so remind me to discuss about that at the end of the class. Let me continue with FX one first. Trade economics is nothing but what you need to know if you're going to uh, enter into an FX deal in this example. Okay, so we're going to talk about types of FX trades and the trade economics. The trade economics is also there in your PPT. If you guys went through forwards and futures, you should have been able to see it. Okay, the first thing that we have is something called as trade date. For short, it's referred to as TD. This is the date in which you enter a contract. Okay, so let's say 1st July. Next, you have something called as settlement date. Sometimes this is referred to as also value date. Just okay. Value date is nothing but the day on which you settle the trade. whatever exchange of cash versus security, or in this case, cash versus cash. Now, if you're doing an FX trade, what is the things you need to know if you're dealing in FX trades? What's the first thing that when you're doing an FX trade with someone, what are the things, what do you need to know first? Bid and ask price, exchange rate, all correct, but before that, don't you think you need to know which are the currencies that you're dealing with? Yes or no? You need to know what are the currencies, right? So you have CCY1, currency 1. So hypothetically, let's say I'm taking dollars. And then you have CCY2, let's say euros. Okay. Then you have something called as notional 1, or denoted as NO1, which is nothing but the amount of US dollars. So let's say I know why it's taking Indian decimal system anyway. So I'll write it here. This is amount of USD, meaning of currency 1. Then you have notional 2. And this is obviously the amount of, let's say, currency 2. So in this case, it is amount of EUR. Okay. So you have the currencies that you're dealing with, and you have the notionals that you're dealing with. Next, you need to know the direction. So let's say buy USD, sell EUR. Okay. Next obvious thing you need to know is the exchange rate. So let's say 100. And because this is predominantly the OTC market, you also need to know who's your counterparty, meaning who's the party that you're dealing with on this particular trade. So these bits here is referred to as your trade economics. In this case, it's more specific to your FX trade. Is everyone clear with this? Yeah. Now, if you noticed here, the settlement date equal the trade date. 1st July, 1st July. Correct? Yes or no?
Yes.
This type of FX trade is referred to as a cash FX trade. Okay? So let's say if the settlement date equals 2nd July, provided these are all business days. In this case, the settlement date equal trade date plus 1 day. Trade date plus 1 day. So 1 plus 1, 2. Settlement date is 2nd July. This is referred to as a TOM trade. Okay. If your settlement date equal trade date plus 2 days, this is referred to as a spot trade. Okay. If your settlement date equaled trade date plus anything greater than 2 days, this is referred to as a forward FX trade. So these are the trade economics. These are types of FX trades. Then we have something called as FX forwards here. So this is a derivative. Okay. You have FX futures. You have FX options, where FX for futures and options, what are the underliers? What are the underliers, guys?
Currency.
Currency, exactly. So you have FX futures, FX options, FX swaps, and you have your NDF contracts, which we will discuss after this. Okay. So types, you have cash spot TOM, and write it here. So cash TOM spot, and you can say FX forwards. Okay, so types of FX trades, and this is the trade economics of a FX trade. Okay, so write this down and then we'll discuss what are NDF contracts.
I have a question. So here you're saying cash, term, spot, and forward. These are the different trade life cycles, right? Again, for futures, option swaps, again you mention it as cash, term, spot, and forward. So I was thinking for each derivative like futures, you will have term, cash, spot, and forward. Not forward, but at least the first three. Ma'am, can you hear me?
Oh, sorry, Saujanya, I just went to get water. What was your question?
The question I had was, ma'am, you have mentioned that cash, term, spot, and forward based on the execution and the trade date. It is those three types. So again, for futures, options, swaps, and contracts, you have separately called out cash, term, spot, forward.
No. These are the types. This is 1, 2, 3, 4, 5, 6, 7, 8. We have 8 types of FX trades.
Okay. Got it. Yeah.
Done writing, guys? can I move on to the next topic? Swaps it will be covered in swaps class, Nikhil. I think next weekend you guys have the swaps class. It will be 2 classes. But I'm not taking that. I think it will be Rakshit will be taking. Okay. So, to move on, the next thing that we're going to talk about is, okay, so trade economics of forward contracts. So you have trade date, you have settlement date, you have direction, whether you're going long or short. Long meaning buy, short meaning sell. Then you need to know what is the asset or underlier that you're dealing with. So in this case, we took example as Facebook shares. So the underlier is equity. Then you need to know the price, and this price will always be per share or per underlier. Okay, it won't be for the quantity of this thing. Next, you need to know the quantity that you're buying or selling and the counterparty that you're. So this is your trade economics of a forward contract. Is this clear, guys? Yeah. Trade economics of a futures contract. By the way, forwards are always traded in which market? OTC, correct.
OTC market.
Yeah, and futures is traded always in?
ETF, exchange market.
Exactly. So, trade economics of a futures contract. So, we need trade date, which is the day you enter the contract. Obviously, need settlement date, but now here's the thing. When you execute a futures trade on the exchange, the settlement date is standardized. The settlement date will always be the last Thursday of the current month, or you can choose the last Thursday of the next month, or the last Thursday of the month after. So if you've taken 1st July, your settlement date will be 30th July, which is the last Thursday of the month. If you don't want 30th July, then you can have your settlement date as 27th August, which is the last Thursday of August. If you don't want August, you can have the settlement date as 24th of September, which is the last Thursday of September. Not more than that. The exchange won't give you that option of going more than 4 months. Okay, but what it means is, if let's say you don't want settlement as last Thursday, you want it somewhere in between, the exchange will tell no, it is standardized for everyone. Is that clear? Whereas when it comes to forward market, you want settlement today? Sure. You want settlement 2 days from now, 3 days from now, 4 days from now, 5 days from now, anything. It's a customized market. Is this clear, guys? Guys,
Hello.
Yeah, what, Nikhil?
Yeah, ma'am. Like we have to roll over a position if we want.
Rollover can happen. Yes, you can opt for rollover at the end of the month, or if you don't want a rollover, then you have to select a settlement date, right? So when you're selecting a settlement date, you have to select only the last Thursday of the current month. If you don't want this month, you can choose next month's last settlement date. If you or last Thursday, if you don't want the next month, the month after that, only up to 3 months, not more than
So
that.
I can choose in the current scenario of the after 2 months date. last Thursday.
Last Thursday, yeah.
So I don't have to roll over, like I have to
You
first sell
don't. Then
and
MTM
buy in the
will,
next month.
no, then MTM will just continue from day one till your settlement date.
Okay, ma'am, and the expiry in the case of actually options, also can you tell me?
I'll come to options. Let me just finish with the futures this thing.
Okay.
Next thing you need to know is direction. So either you're going long or short, long futures or short futures. So long futures is your buying, short futures is your selling. Then the underlier that you're dealing with. Then the number of contracts you want to buy or sell. Then you need to know the lot size. Lot size is also standardized, meaning the number of underliers that make up for one contract. This was definitely discussed in your futures class, lot size. Yeah. So lot size is also standardized, meaning the exchange sets the lot size. You cannot go and argue with the exchange saying, no, I want lot size to be 200 or 1000. Okay, it is standardized. And then you have the price. So you don't have counterparty here because it's a exchange traded trade. So this will become your trade economics of your futures trade. Trade date, settle date, direction, underlier, contract size, lot size, price, and where settlement date and lot size are standardized components. Is that clear? Okay. So trade economics of an options contract now. So this anyway, I'll leave you guys to note it down in the video. It will be there, so you can take it down then. Yes, you have to need to learn this, Preeti, because when you do your trade life cycle, these aspects will be important in one of the parts of trade life cycle.
These are the core trade economics.
Exactly. Right? Yeah. So you need trade date, as usual. Okay. So let's say 1st July. Okay. You need now the style of option, whether it's going to be American, European, or Bermudan. So let's say European.
Sorry to interrupt you. Like after American and European, they can ask anything, any option. Like there is many there.
No, you need to choose when you are doing an option, which style of option you want to do. Whether you want to do an European style of option where you only get one chance to exercise.
I have to learn all. That's what.
Yeah.
Okay.
Okay. Wasn't this discussed, styles of options?
No, ma'am, this was not covered.
Okay, can someone
I've seen the elements.
Make a note? If we have time at the end of the class, we'll discuss this.
Okay.
I am writing.
Then you have the expiration, not expiration, you have the exercise date. Okay, so we'll put 28th July. Then you have the expiration date, meaning when the option expires. So let's say 30th July, provided all of these are working days. Okay. Then you have the underlier that you're dealing with. Okay. So again, for example, let's take Facebook shares. Okay. Now, on the option contract, or rather direction, you can say. So let's say long call. That means on the option contract, you're going long, and the underlier you're calling. That means it's what? If you're calling, that means what you're doing. If it's a call option, what are you doing, guys?
Buying.
Exactly. Long
So you're
call,
buying
you're buying.
in the market.
Okay.
Only bullish in the market.
Okay. And then how many contracts, option contracts are you buying? Okay. Now, if it is exchange, then you have lot size. Okay. Then the most obvious thing, you have your strike price and you have your premium. Okay. If it is OTC market, you have counterparty, because options is the only derivative that can be traded both on the exchange and in the OTC market. Is that clear? So this becomes your trade economics of your options contract. Is everyone clear with this? Yeah. So I'm going to move on because you can see this in your video recording and you can make a note of it. Okay. So we are going to discuss what are NDF contracts. NDF stands for non-deliverable forward contracts. So before we understand what is NDF contracts, we need to understand what's an NDF currency. NDF currencies are those currencies that are highly volatile and have low liquidity. What does it mean by volatility or high volatility?
Not stable.
Not stable. What else? It fluctuates, the exchange rate fluctuates a lot. Okay. What do you mean by low liquidity?
Returns are less, ma'am.
Low liquidity. Not easily
It
convertible.
is not easily tradable.
Yeah, tradable. Not easily convertible or not easily tradable. Okay. Our Indian rupees, for example, is classified as an NDF currency. By who? RBI, which is a Anupam, it's clearly written here. No, what is NDF? Are you paying attention? Okay. Okay, so our Indian rupees is classified as an NDF currency. Who classified it as our central bank, which is the RBI. Why it is classified as an NDF? To protect the strength of the currency. Let's say, hypothetically, if a foreign country or company has rupees with them. Now, in order to get their domestic currency and to get a better deal on their domestic currency, which is the obvious place they would, obvious market that they could come to exchange the INR for their domestic currency? Do you understand my question? Okay, so let me put it this way. There are couple of, let's say there are 20 American companies and 20 European companies who all have some rupees with them. And when I say have some rupees with them, I don't mean 1 or 2 rupees. I'll say maybe crores of rupees with them. Okay, for some reason. Now, is rupees of any use for them? No. What is the obvious thing they would want to do? Exchange or convert to their domestic currency or maybe another foreign currency. Yes? Which is the best market for them to do that? To get more of the domestic currency they want or more of the foreign currency they want? obviously FX market, but let me rephrase it. Which geographical market is the best for them to exchange the rupees for a foreign currency or their domestic currency? Indian market, correct. Who was that? Komal. Exactly. The Indian market. Why? Because our currency is weaker. So what will happen is, for the rupees, they can get a better deal for their foreign currency or domestic currency. Agreed? Anupam's bulb just now lit. Yes, Indian market. Okay. So now, if all of these guys come and dump the rupees in the Indian market, what's going to happen to the value of the rupees? Sunny, appreciate. Are you sure?
Value of the rupee depreciates.
Exactly. The value of the rupees will depreciate. If the value of the rupees depreciates, what is it going to affect?
Overall Indian economy.
Exactly. It will affect our economy. So in order to protect the strength of the rupees, it's classified as an NDF currency. What that means is, foreign countries or companies cannot come into the Indian market and freely exchange the rupees for some other currency. However, they can exchange the rupees with the central bank. Why? We know the reason why they are banned from or not allowed to exchange rupees for a foreign currency or their domestic currency, because if they float excessive rupees, then it will cause a adverse effect for the economy, Indian economy. But they are allowed to exchange the rupees for a foreign currency with the central bank, in our case RBI. Why? The answer is not very complicated. It's very simple. Why? So, Jenna, yes, they'll have reserve of foreign currency. That is correct. But why can they do it with the RBI and why not in the market? Very simple. The answer is right there.
And to protect the strength of the currency.
And that we agreed, no, to protect the strength of the currency. But then why with the RBI they can exchange the rupees and get a foreign currency? Why market they are not allowed? Because obviously if they put excessive rupees in the market, it will cause a problem. Sorry, someone else was saying something.
So the rate at which the RBI exchange the money, that's different from the market. So they will charge higher. So
Okay, that could be one explanation, but the most simplest explanation is, what is the sole purpose of RBI?
like,
What is he? He's a regulator, correct?
yeah,
Isn't he the one who controls the money flow in the market?
yes,
So if you go give him the excessive INR, it's up to the RBI whether they want to float that in the market or not.
right.
Right? So what will happen is, these foreign companies or countries can go to the central bank and exchange the rupees in this case, for example, and take a foreign currency. Okay, if they have the rupees with them. So that way, the RBI is protecting the Indian economy from preventing these guys in floating excessive rupees in the market. Is that clear, guys? Okay. Having said that, investors take advantage of NDF currency's weakness against deliverable currencies. So deliverable currencies are those currencies that are not NDF currencies, like your major currencies and your minor currencies or your exotic currencies. So where's that example? So there are some more NDF currencies that will be listed in your PPT. So you have Indian rupees, Russian rubles, Chinese yuan, South Korean won, your Mexican pesos, your Chilean pesos, your Taiwanese dollars, your Vietnamese dong, your Venezuelan bolivar, so many other. Okay, so these are your NDF currencies. If they're paired with any of these currencies are called as deliverable currencies, meaning on these currencies you will not realize any profit or any loss. You will flatten out the currency. So that is what is an NDF contract actually. So NDF contracts are a combination of two FX trades with the same settlement date but different trade date. The aim is to make a profit on the deliverable currency while we flatten out the NDF currency. Is this clear? Don't worry, I'll show you an example of how it works. But is the definition okay? Do you understand what is an NDF currency? Why it is classified as NDF currency? Also, what is an NDF contract? Is this clear to everyone? Preeti, I'll show you an example. It will make more sense then. But you've understood what is an NDF currency, right? Preeti, Saurabh, have you understood what's an NDF currency? What's the confusion, Preeti? NDF is, I don't understand what you have typed, Saurabh.
I think he's saying NDF. I got it.
Okay. What about you, Preeti? What's the confusion?
Actually, from the starting, I understood like its full form. Then I was with you till high volatility and low liquidity. After that, I just was not able to keep up with you.
Daydreaming about something?
No, actually,
Sunday's over.
I was reading everything so that I can understand because I was not able to get. That's why.
Pay attention now. Okay?
Yeah.
So NDF currencies, for example, I showed you a list of NDF currencies. There are some more that is there in your PPT. Indian rupees is also a NDF currency. Who classified it as an NDF currency is our central bank. Why it classified it as a NDF currency is to protect the strength. Reason being,
Okay.
if there are foreign countries or companies that have rupees with them, the place they would exchange the rupees for their domestic currency or another foreign currency is the Indian market. Because our currency is weaker, they'll get a better deal in the Indian market. Now, if all of these guys come and exchange the INR for some other currency, they will be floating excessive rupees in the market. If they float excessive rupees in the Indian market, the value of the rupee is going to go down. And it's going to affect our economy. Okay?
Okay.
So, in order to prevent that from happening, the central bank has classified it as an NDF currency. So, what it means is now, if any foreign country or company wants to exchange INR, they cannot do it freely in the Indian market. They have to go to the central bank, in our case RBI, exchange the rupees for whichever foreign currency they want. The reason now is RBI also has a reserve of foreign currency with them. Additionally, RBI is the one who regulates the money flow in the market. So he can either float that INR in the market or he can keep it in the vault. So he can protect the strength of the INR so it won't affect the economy. Are we clear till here?
Yeah.
Okay. However, what can happen is because inadvertently the NDF currencies are weaker than your major and minor currencies, or even most of your exotic currencies, what can happen is investors can enter into something called as an NDF contract, which is called as a non-deliverable forward contract, where you try to realize a profit on the deliverable currency while you always flatten out the NDF currency. So we discussed flattening out earlier in class, right? Flattening out is
right.
You realize no profit, no loss. Okay. So you'll always flatten out the NDF currency. Now, based on your speculation on the deliverable currency, you can either realize a profit or you might realize a loss if you speculated the wrong way.
Okay.
Okay. Clear till here?
Yeah.
So now we'll take an example. Let me see.
Okay, so this will happen with all NDF currencies. We are just taking example of INR.
Yeah, we have, see, these are some of your other examples of NDF currencies. So these all are classified by their central banks as NDF currencies.
Okay, fine. Yeah, thank you.
No problem. Here we go. So, are you guys with me so far? So, example of an NDF contract. Okay. So, let's say we have Morgan Stanley, we have Goldman Sachs. Morgan Stanley is saying that USD will appreciate against INR, where INR is the NDF currency, and GS speculates the opposite, meaning USD will depreciate against INR. With me so far? Okay, so both of them enter into a NDF contract where you have a main leg and you have a fixing leg. Now, in the main leg, your trade date is 1st July, your settlement is 30th July. Okay, let's say exchange rate is 70, counterparty is GS, and we're looking at this from Morgan Stanley's point of view. Okay, so what has happened is, hang on. So Morgan Stanley is speculating that the USD will appreciate. So what they'll do is they'll buy US dollars in the first time or first round. So they are planning to buy 1 million US dollars. So they have to sell 70 million INR. Agreed? Yes or no? Yeah. Now, the main leg is done. We have something called as fixing date, which will always be 2 days prior to the settlement date. So in this case, it's 28th July because the settlement date is 30th July. Now, this date becomes a trade date in the fixing leg. So this is the second leg of this FX trade. Okay, or this NDF contract. Second leg of it, which is called as fixing leg. So on 28th July, what will happen is, on the fixing date, you go to the fixing source to find the fixing rate, meaning fixing source is the central bank. What is the rate they publish for USD versus INR? And let's say on 28th July, they publish a rate of 75. That rate is plugged in here. Now remember that we already discussed that we will always flatten out the NDF currency. Yes or no? Yeah. So if we sold 70 million, we are going to buy the exact same amount. That means we have flattened out the INR. But now, for 70 million INR at the rate of 75, how much US dollars will you have to sell? Which is 933,333. The remaining, is it a profit or a loss for Morgan Stanley? Is it a profit or a loss?
Profit.
Why is it a doubtful profit, Saujanya? You don't sound confident.
Yeah, because there is an appreciation, right? And you have
Correct.
standard. Yeah.
Okay, it's a profit. Now, if Morgan Stanley has made a profit, who's made that loss? Exactly. So on 30th July, what will happen is GS will pay that $66,667 to Morgan Stanley. Now, point to note, in an NDF contract, in the first leg, there is no exchange of 1 million US dollars versus 70 million INR. There is no exchange in the fixing leg itself. However, at the end, when you realize a profit, if your speculation turns right, on the settlement date, the counterparty will pay that profit to you. Is that clear? Is this clear, guys? As I was saying, in an NDF contract, you have main leg and fixing leg. In the main leg, what we did, as Morgan Stanley, we said we'll sell 70 million rupees, we'll get $1 million. There's no actual exchange of rupees versus dollars here. Is that clear? Okay. Fixing leg, on fixing date, we get the fixing rate, we plug that in, we get the notional, we know one notional already because we have to flatten out the NDF currency. Taking this notional and this rate into account, we get the other notional. Now, for Morgan Stanley's luck, the rate appreciated or dollars appreciated, so he's made a profit. That profit is paid to him from Goldman on the 30th of July. Is this clear? What if 69? Sorry. Oh, you mean if the rate goes down, then what will happen? Will Morgan Stanley make a profit? Loss. If he's made a loss, then who has to pay who? Exactly. MS or Morgan Stanley will pay it to GS. Clear? Okay. So let's say if it went to 65. Okay. If it went to 65, then this would become so now this loss of 76,923 would be paid to who? Goldman Sachs on the 30th of July because the speculation went wrong on behalf of Morgan Stanley. Clear? Have we understood what is an NDF contract, folks?
If it's a loss, then Morgan Stanley will pay GS, right?
Yeah, because his speculation went wrong, right?
Okay, yeah.
Okay. Are we guys okay with what is NDF contracts or how NDF contracts work? Yeah. So write that down, and you also have a class work. So change this. So this will be your homework or classwork. Okay. Change this as well.
Ma'am, for the final exams, will we be asked questions like this? Any like numerical questions, or it will be more theoretical?
It used to be MCQs, but yes, there used to be numerical listing. I'm not sure how it is now because it's been quite some time since I left Marticus. Might have changed.
Okay.
Okay, so this will be your classwork or homework rather. So I'm not putting the direction here. You you do know that you have to realize a profit on the GBP, right? You can't realize a profit on the Philippine peso because that is the NDF currency. So it needs to be flattened out. Okay. So take 2 minutes to write this. Then I just have a small bit left to cover. And then we can move on to your whatever doubts you had to clear. And then we can wind up the class. Okay. Done?
Hello.
Yes.
Where is the rate given between the GBP and PSP?
I've written it here, no?
No, exchange rate I'm asking.
This is the exchange rate only.
Okay, 135.
135, 130. Okay. Done?
They can ask this type of question in the interview also.
Yes.
Okay.
So you have to be clear with the concept. So if they tell you to start calculating something, you should be able to do it.
Have so much time, like they will ask the numericals and all.
Yeah. See, it's all depends on how you set the interview this thing. If, to be honest, interviewers in 3-4 questions they can gauge how good you are at your this thing. If you're good, they'll tend to ask more questions. If you're not good, they won't ask that many questions. And again, it depends on the interviewer's mood also. So sometimes they
Then they
might
will kill.
be okay with asking 3-4 questions and saying, okay, this person is good enough. Or sometimes they will like go on and ask questions and to see how long you can last. To give you an example, one of our guys who went for a GS internship, he had 8 rounds of interview. So
Might he will be exhausted, like.
the reason why they took 8 rounds is to see when he will get agitated or this thing, because this fellow was very laid back. He was very calm and level headed. So they just wanted to see if he can stay calm and level headed after 8 rounds of interview. So that is also a possibility.
So he got the result, ma'am?
Yeah, he got through.
Okay.
Okay, so what is left over is something called as FX settlements. Okay, so FX trades, I'm not talking about your what do you say, swaps, options, and futures. Okay, that settlement is different. So futures, you have mark to market. So settlement will happen on a daily basis. Forwards is a one-time settlement, right? And your swaps you'll learn in your FX or in your swaps class. Okay, and options is if it's an exchange, it will have MTM. If it is an OTC market, based on the exercise date, whether you're in profit on the exercise date and on the expiration date, you'll pay premium or either buy or sell to the writer. Okay, so let's say between GS of these are a bunch of FX trades GS has done with these counterparties. So a buy I've denoted as a plus and a sell I've denoted as a minus. Okay, is everyone clear till here? So let's say the first FX trade GS is done with Morgan Stanley, where it is bought this much US dollars and sold this much GBP. Is everyone clear till here? Yes or no? Yeah. The next trade, they have sold this much US dollars and they bought this much GBP, again with Morgan Stanley. Okay. Then the third one is they've bought this much US dollars and they sold this much euros with JP Morgan. Okay. Now your FX trades can settle gross or net. Gross meaning these individual trades will settle like this. They'll exchange USD versus GBP, then again here USD versus GBP, and again USD versus euros. Now for each of these trades, there will be a separate transaction cost. So let's say for each trade, the cost is $1 per transaction. For these three, how much GS would end up shelling if they're doing these three? Gross method, like this. Did you understand my question? So my question is, GS has done these three FX trades with these, or if you want to make it more interesting, I'll put DD here, with these three counterparties. Okay. Clear till here? Now for each FX trade transaction, there's a cost of $1 associated. So if they're doing three FX trades, what is the cost that GS would have to pay? $3. Yes. Now, that is how the FX trades are settled in a gross way. Okay. There's a concept called as netting. Now, let's say we have the same this thing, but these first two trades, the currency pair is the same. Yes or no? Currency pair is the same or not? Yes. Counterparty is the same? Yes. And let's say the settlement date is 1st July on both of them. So when the currency pair is same, the settlement date is same, and the counterparty is same, then you can net these two trades. So now this will be minus 3,000 US dollars, and this will be minus 1,500, I think, $1,050 or $150,000 with Morgan Stanley. So instead of doing two separate FX trades, it becomes one FX trade. Did you guys understand what I'm telling you? It got netted. Okay, it got netted. The rules for netting though is currency pair has to be the same, settlement date and counterparty same. So if this was DB and the settlement date was 1st July, it can't be netted even if the currency pair is the same. Okay, if the currency pair is the same and if the counterparty is the same and the settlement date is the same, then only it can be netted. Let's say if this was 2nd July settlement date. Now, even if the currency pair is the same and the counterparty is the same, it cannot be netted because the settlement dates are different. In order for netting to happen, these three criteria should match. Is that clear? Okay. So this is settlements in FX. It can either settle in a gross way or it can settle in a netted way. So write this down and then we can have a few minutes to clear your doubts clearing session. Okay. Let me know once you're done.
Ma'am, now after this only swaps. Now after this only swaps is left for first term, na?
Yes, you have 2 classes of swaps, then you guys are officially done with level 1 and you'll have another Viva. By the way, I got your Viva scores and I'm very disappointed with the scores that you guys have gotten. So, to stress on the point that you guys need to revise and you guys only have classes on the weekend, I think you can spare at least half an hour every day in the week to go through your notes and go through your topics and practice.
Ma'am, how do we know about our scores, ma'am?
Your scores Rakshit will send to you guys.
Okay.
Yeah, so I saw scores and I'm not that happy with your scores. It's a little disappointing.
Ma'am, what's the highest score that anybody got?
I think it was a 3.5.
Okay.
So how much?
3.5 is the highest I've seen, I think. I just had a glance of it and then I saw the scores. I was not that happy, so I didn't bother to see. Oh, there's a 4. Okay, out of 5, by the way, this is.
Hello.
Yes.
How long, like level 2 have these topics only? Like, how long is the level 2? I want to.
Let me see. You have exchange trade life cycle, OTC trade life cycle, you have settlements, reconciliation, and custodian, which is one class. Then you have AML KYC, which is one class. Corporate actions, asset management, regulatory risk and environment. I'm missing something. Reference data management. So you have about 8 domain classes, but you also have soft skill classes with that, a couple of soft skill classes. So 8 Domain classes meaning at least 4 weekends.
Okay.
Ma'am, right now I checked, my score is 4.5 out of 5 on my mail.
Oh, sorry, I missed that. Oh, congrats. Piyush is the highest scorer. So I'm not disappointed with your score, Piyush.
Thanks, ma'am.
If this was out of 10, then I'll be disappointed with all of your scores. But I think it's out of 5. Yeah, I think it's out of 5.
No, it's out of 5.
Yeah, it's out of 5. Right. So, have you guys finished writing the netting bit or FX settlement? Yes, no, maybe. It's tea time. So I want to wind up. Okay. Right. So, what is left is just a little bit of jargons. So jargons used in FX trading. So currency pairs have nicknames. Some example or like 2 examples. There are quite a few which is there on your PPT as well. So a Euro GBP pair is referred to as a channel. So if your trader says I want to trade in a channel, he means a Euro GBP pair. If he says I want to trade in a Ninja, he means a USD JPY pair. If he says I want to trade 1 yard of channel, that means he wants to trade 1 billion of Euro GBP pair. Okay, if he says $1, he means 1 million. So these are certain jargons used in FX trading. Okay. Right. So we had couple of things to cover. I think we said we'll do it in the end of the class. One was trade economics, which we discussed already, right? So trade economics of your forwards, futures, and options. Yeah. Yes, no, maybe. Yeah.
Ma'am, I had a doubt. So you gave a question for accrued interest. I think 2 weeks ago. So could you send the answers or could you
I
display the
already
answers of that?
sent it to Rakshit. Didn't he give it to you guys?
I have received, but the last.
No, ma'am, we didn't get it. Can you forward it to me at least? I didn't get it.
Hang on. Here, I'll copy paste it in the chat. Okay. Will that do? Or what I'll do is hang on. I'll just this thing, then in the video you'll be able to pause it. So this should be your first one. This is your second one. And this is the third one. Okay. Done? What other questions or doubts?
Like the warrants, what are the warrants?
Warrants is not part of your curriculum. So warrants is basically, to give you a gist of what is warrants, it's basically a new issue by the company in terms of shares, but it gives the investor a sort of like a strike price at which they can buy, with the stipulation that if the market price goes above a certain pre-agreed price.
So in the LMS also assignment is given of for the DCC. So can I get the answers of that also?
Sorry, LMS what?
In the LMS assignment is given on the DCC day confirmations.
Then you need to reach out to
If you,
Sadaf, because I gave you questions that I just made up. I didn't take it from LMS, so I don't have access to
okay,
LMS actually.
okay.
Ma'am, can you explain styles for options that was not covered?
Yes, exactly. That was the one that was missing. So styles, we first have European style. So basically in European style, you just get hang on. So let's say you have trade date 1st of July, okay, and you have settlement date or the expiration date, meaning the day the contract expires, as 30th of July. Then your exercise date will always be 2 days prior to the expiration date. So in this case, it will be 28th July. This is a European style of option, meaning, let's say you are doing a long call at a strike of 200, and let's say premium is hypothetically 50, okay? On 28th of July, the spot price of the underlier is 300. Now, as a holder of the option, on 28th of July, will you exercise or expire? Have you understood my
Exercise. Exercise.
Exactly, you'll exercise. Why? Because the market price is higher than the strike price and you're doing a long call, meaning you want to buy the underlying. The strike is cheaper than the market price. So you exercise, you decide on 28th of July to exercise your option. That means on 30th of July, what will happen? You will pay the premium to the writer and you will buy the underlier at 200. Yes or no? Yes or no, guys? Y as in yes, Nikhil, or Y as in WHY? Okay. So basically, European style of option is you just get 1 day to choose to whether you want to exercise your option. Otherwise, automatically on expiration date, it will expire and you will pay the premium to the writer. Is this clear to everyone? Yeah? Okay. The next one, because the Americans were not happy with anything, is the American style of option. Okay, where any day between the trade date and the expiration date, as a holder, you can choose to exercise your option. There is no particular set date. Is this clear? Okay. And then you have your Bermudan style of option, where you have preset intervals in which you can exercise or expire option. Okay, so your first chance is not on 1st July because that's when you enter the contract. Okay, Your first chance is, let's say, maybe 10th July. Okay. Your next chance or I won't put date 1 and date 2 because that will get confusing. Is 20th July. And then you have your expiration. So in Bermudan style, you have preset intervals in which you can exercise your option. Your first chance is 10th July. If you don't exercise your option, then your next chance to exercise is 20th July. If you don't exercise your option, then automatically on 30th July, the option will expire and you'll pay the premium to the writer. Let's say if it's this long call option, premium 50, and let's say on the 10th of July, the market price is 150. Would you exercise or expire? Exactly, you'll expire because market is cheaper. Okay, if you want to expire. If you don't want to expire or exercise, you won't do anything. Your next option or your next chance is 20th of July. Right? You'll see what are the market. So, by the way, if you've exercised your option contract of 10th of July, you can't exercise it again here. Only one chance you get, but the difference is you get preset intervals between the trade date and the settlement date. Is that clear? Okay. So
Yes, yes.
write this down. European, American, and Bermudan.
The basic difference between these markets is the number of days in the execution and expiry XPE.
They are not different markets, Piyush. They're different styles of exercising, you could say.
Type.
Yeah, it's just a style in which.
Okay, means the basic difference is between the number of days.
Yeah, so in European, you only get 1 day, which is 2 days prior to this expiration date or the settlement date. If it is American, any time between trade date to expiration date. If it's Bermudan, you get preset intervals. Yes, sir. Once you've exercised, then you cannot exercise it again. You only get one chance to exercise the option. Okay. In India, every week Thursday is expiration. No. In India, on options on the exchange, if it is OTC market, it depends on when you have your expiration date and whether you're doing European style or American style or Bermudan style. But options predominantly in the Indian market are mostly exchange traded. So if it's exchange traded, it is the last Thursday. On the exchange, you can't have Bermudan or American. Okay, it's mostly Euro. It's like a European style.
Hello. Well, I have a doubt. Like every Thursday, we say there is expiry of the options. That's why I'm asking. Like every week, option expires.
They could
Past
be.
options
I'm
expire.
not very well versed with the Indian options. This thing. So there are some option contracts that can be expired on every Thursday, but mostly it's the last Thursday of the month.
Okay.
Okay. I've never worked Indian markets, so I'm not sure. I only worked US and European markets. Any other questions?
was asking about the reserves with the RBI.
What was your question about reserves?
Yeah, it was clear like regarding they're having the US dollar like foreign reserve.
Every central bank will have a foreign currency reserve that they keep. Saujanya, predominantly in the market, they use European, American, and Bermudan. Asian options in the Asian market, options is not that predominant actually. They usually don't. They usually stick to option strategies and the basic types of options.
Ma'am, one more thing. The status of the option also was not covered. Should we check with Rakshit sir, or I mean, I just wanted to bring this up.
Status or styles?
Status, ma'am. Status and styles both were not covered.
I think status. I'm not getting what you're saying. Status.
In the money, at the money, and what was the other one?
That was not discussed. Payoff.
No.
Option payoff was not
Payoff.
discussed.
Payoffs was discussed. The 4 types, right? That was discussed, but the status of the option was not. Is this part of payoffs?
Yeah.
Payoff. Sorry.
ITM, OTM, and ATM. It's part of the payoffs based on the type of options.
Okay.
It was not discussed.
Maybe it was, and maybe I didn't catch the context. I don't know.
So for a long call option, it's always going to be in the money when the spot price is greater than the strike price. It will be out the money when the spot price is lesser than the strike price. And it will be at the money when the price is your strike minus the premium. That means no profit, no loss, which is the break-even point of the option contract for a long call option. Vatsal, you can address your question to Rakshit. As far as I know, they are hiring. Okay. And first you appear for your Viva, Vatsal, which you haven't done. Okay, so that covers the payoff for this thing for your long call. Okay, so similarly for long put, so it's any option when there's a profit for the holder or the writer. That time it's in the money. Okay, whenever there's a loss for the holder or the writer, that's out the money. Okay, whenever it's break even point, and by the way, for any call option, the break even point will always be your strike minus the premium. In your options class, the example for long call, what was the strike and premium that was given? Okay, so if you see at 110 in a long call option, that is your break even point. There is no profit, no loss. Correct? If you look at your workout that you have worked out for long call. Yes or no? Yeah. And if you see a long put, if it's the same strike in premium, at 90 it will be break-even point. No profit, no loss. Same goes for long call. So any call option, your break-even point or ATM will always be strike plus premium. And for a put option, whether it's long put or short put, it will always be strike minus the premium. Okay. All right. Any other questions? Yes, no, maybe.
Ma'am, the company in which will be aligned for the interviews depends on our marks or performance in this program.
Performance in your mocks, which is your type of mock interviews. Okay.
Ma'am, one last question. What is vanilla option?
Your long call, long put, short call, short put are called as vanilla options.
Okay.
Okay, those are the basic options that you have.
Hello,
Yes.
ma'am. When in quote-driven market, we are saying that settlement is not guaranteed because margins are not maintained. What is this line actually trying to convey?
So basically, in quote-driven market, we do not keep any funds in the margin account. In fact, in your quote-driven market, even if the clearing house is involved, we don't have to keep funds in the margin account. Unlike your exchange traded market, if you're executing any trades on the exchange, in order for that order to go through, you have to maintain funds in the margin account. So in case if there's a default from one or the other party, the clearing house will take the funds from the margin account and settle the other party's side. Whereas this doesn't happen in the OTC market. That's why the default risk is very high in OTC. And in order to negate that default risk, in your settlements class, there will be a concept called as central counterparties that will be discussed, which now most of the market regulators are pushing for.
Fine, ma'am. Fine. Thank you.
Yeah. Any other questions? Yes, no, maybe. No from Nikhil. Rest of you folks? All cleared? Divya, no. No. Okay. Okay. So, guys, again, stressing the point that you guys need to revise. You need to be solid on your level 1, the product, right? And in level 2, the focus will be more on the trade life cycle and some of the processes that are there from interview perspective. Okay. All right then. So if there's no other questions, I don't know when I'll have the next class with you guys. So enjoy the rest of your Sunday, but study as well. Interview questions will come from all level, Nikhil. It will depend on which, sometimes it might depend on which process you might go for. You'll have to check with your center, Saurabh, when they'll give the handouts to you. It's just a very concise version of what is there in your PPT. This class...
Handouts, ma'am? Handouts meaning they'll give books.
It's not books also, it's just print out of couple of pages of topic.
Okay.
Okay. Prasad, recording of this class, hopefully by tomorrow evening you'll get, because it takes about a whole night for this to convert into MP4 video format, and then I have to upload it. The extra topics on LMS, Nikhil, is for your information. FYI, it is.
Which we have to memorize, like we have to go through that also, because there are so much of extra stuff is given.
You for your scoring well in your mocks, your
Okay.
PPT and what you've learned in class, your notes is more than sufficient.
That's sufficient.
Yes, those other stuff is
Okay,
additional reading.
Now, one question is there, like Rakshit sir has asked me, like regarding the repo. How is it double collateral? I think
Sorry, what?
repo.
Yeah, what was the question?
Repo, repurchase.
I know
Repo.
what is a repo, Baba. What was the question?
No, I know, you know. The question was he was asking about double collateral, something like that.
Double collateral. The question is not
Something
clear.
like that.
Get the question no proper. What question was it?
I have the answer for it.
What was the question though? I'm curious. What's the question?
Ma'am, question is how repo is known as a double collateral agreement.
Double collateral agreement.
Yeah.
No, ma'am.
Ma'am, because
It's not like that.
Yeah.
It is actually why repo agreement is called or is known as over collateralized loan.
Because additional of the government securities, we are also paying the haircut or the margin along with it.
Yeah. Why is the repo over collateralized, not double collateral?
Yeah.
Because no one
Over
will pay
collateralized,
double
yes.
collateral unless they're so
Because along with the government securities, you are also paying the haircut over it.
yeah. But fun fact, not all repo agreements are generally over collateralized. However,
Yes, ma'am.
when you do stock borrow lending, that is most definitely over collateralized. When you lend stock or when you receive collateral in return. Oh, sorry, I missed stock borrow lending. So you have about 9, I think, domain classes in your level 2 and 3 mixed together. Okay.
So only 9 classes are left for us now.
Domain classes, Piyush. You have even your soft skill, na?
Yeah.
Yeah, Prabhakar, because till November end almost it will take, I think. Because you guys only have 2 classes, no, on the weekend. If you have a weekday batch, then you would finish in 1.5, 2 months max. Because weekday has like 4 days a week versus weekend. Okay. Alright. So if there is no other questions, then shall we wind up for today?
Sure, ma'am. Sure. Thank you.
No problem. So again, hope you guys have